In September 2008, a 158-year-old investment bank collapsed overnight. $600 billion of wealth vanished into thin air. Over the next few months, retirement accounts disintegrated, millions of people lost their jobs, and the global credit markets froze solid. But what if I told you that the worst global economic disaster since the Great Depression didn't start with a high-stakes corporate conspiracy? It started with a lie so simple, so incredibly comforting, that you could fit it on a single highway billboard. Why rent when you can own? This is the story of how cheap money, raw financial greed, and a house of cards built on bad math wiped out $19 trillion of American household wealth. And why the people who lit the match got rescued while everyone else got wrecked. Let's rewind to 2002. America is nursing a massive hangover from the dot-com stock market crash, and the 9/11 attacks have left the economy twitchy. To stop a recession, the Federal Reserve decides to slash interest rates to basically 0%. Suddenly, money is cheap. Borrowing is absurdly easy. And across the nation, America's favorite hobby shifts from baseball to buying real estate.
Congratulations, my friend. You are officially approved for a $500,000 mortgage.
Wait, I fry burgers at McDonald's and make $40,000 a year. Are you sure?
Don't worry about it. We've got an adjustable rate, balloon payment, ninja loan with your name on it.
Ninja loan? Like, do I get throwing stars?
Better? NINJA. No income, no job, no assets, no problem.
Traditional lending standards launched straight out the window. Risk assessments? Too slow and boring. Down payments? Entirely optional. If you had a warm pulse, you got a mortgage. But beneath this nationwide open house party lay a single dangerous assumption. Housing prices only go up. If a buyer defaults, the bank can just sell the house for more money next week. It was a perfect gold rush until Wall Street decided to get creative. See, local banks didn't want to hold on to these risky subprime mortgages for 30 years. That was too slow. They wanted their cash back immediately so they could write more loans and collect more fees. So they sold the mortgages to Wall Street investment banks. And Wall Street decided to perform some high-level financial alchemy. They bundled thousands of these risky, unstable mortgages into a single giant package. They called it a mortgage-backed security.
This mortgage bundle is literally a sack of garbage. It's full of bankrupt baristas, unemployed gym bros, and loans with zero documentation. I can't grade this as safe.
That's a shame. Because if you don't grade this as a safe, prime grade asset, I'll take my $100 million rating business to the agency down the street.
On second thought, smells delicious. A AA rating approved.
The rating agencies were getting paid directly by the very banks they were supposed to be auditing. It was like hiring a food critic, then telling them they wouldn't get paid unless they called your raw, rotten chicken a Michelin-starred masterpiece. And to make it even more complicated, they blended those mortgage bundles into complex structures called collateralized debt obligations. Through sheer financial complexity, toxic waste was magically transformed into pristine, institutional-grade gold. The party was raging, but a few oddball skeptics and hedge fund managers read the fine print. They realized the entire American housing market was resting on a foundation of shifting sand. They wanted to bet against it, but the product didn't exist. So they marched into Wall Street's marble fortresses and asked them to build it. And Wall Street, smelling easy money, happily cooked up the weapon of mass economic destruction, the credit default swap. Translation for a 5-year-old. A credit default swap is an insurance policy on those mortgage-backed investments. If the mortgages fail, the insurance pays out a massive jackpot. But here's the wildest part. You didn't even have to own the investment to buy the insurance. It was the mathematical equivalent of buying life insurance on your elderly neighbor's grandma, and then actively rooting for her to slip on the stairs tomorrow. Wall Street banks happily sold these swaps, collecting millions in steady monthly premiums, fully convinced the housing market could never collapse. The leverage climbed to astronomical levels. The Jenga tower of cards was 20 stories high, made of bad debt, zero regulations, and blind optimism. And then the wind blew. In 2007, the unthinkable happened. Housing prices stopped rising. Suddenly, those adjustable rate mortgages reset, and monthly payments doubled. Millions of homeowners defaulted. The AAA mortgage-backed securities didn't just lose value, they turned into financial plutonium overnight.
Sir, nobody wants to buy our mortgage bundles. The market is down to zero.
What do you mean, zero? We have $10 billion of those on our balance sheet.
Well, now we have $10 billion of toxic garbage. We are completely insolvent.
Lehman Brothers, a legendary Wall Street institution that survived the Civil War, the San Francisco earthquake, and the Great Depression, declared bankruptcy. Panic turned into an absolute wildfire. Because nobody knew which bank was holding the radioactive plutonium, banks completely stopped lending to each other. The global credit markets froze solid.
Hey, I need our standard seasonal line of credit so I can pay my 60 employees their salaries on Friday.
I'm sorry. There is absolutely no liquidity. We are closed. Good luck.
It was like someone yanked the power cord on the global economy. Businesses couldn't fund operations, families couldn't get mortgages, and the job market was completely vaporized. Main Street was in a violent freefall. By late 2008, the US government faced an impossible, agonizing choice. Let the entire global financial system burn to the ground, or use billions of taxpayer dollars to rescue the very guys who lit the match. They chose the latter. Under the Troubled Asset Relief Program, the government created a $700 billion pillow for Wall Street to fall on. The Federal Reserve started printing money out of thin air to buy up the bank's toxic mortgage junk. A process called quantitative easing. AIG, the insurance giant that greedily wrote trillions in credit default swaps, received over $180 billion in aid. The markets calmed down, the bank survived, but the scars on Main Street were permanent. 10% unemployment, 8 million American jobs gone, 4 million families evicted from their homes, $19 trillion in household wealth vanished, and the absolute kicker that fueled a generation of rage? The executives who designed the radioactive products got bailed out, walked away with multi-million-dollar bonuses, and not a single major Wall Street CEO went to federal prison. In 2011, thousands of people gathered in New York with a simple, unifying realization. The system was rigged. Wall Street had successfully privatized the profits and socialized the losses. A generation grew up knowing that if a massive bank messes up, they get a government rescue hose. But if you mess up, you get wrecked. Trust in our financial institutions burned to the ground, and the ashes are still smoldering in our politics today. But as we look at the modern markets, we have to remember the ultimate rule of financial history. The next system-shattering crisis won't look like a housing bubble. It won't look like subprime mortgages. It will look perfectly safe, highly profitable, and completely inevitable. Until it isn't. Don't forget to like, subscribe, and share this with someone who needs to see it. Next time, we're diving into another financial illusion.